Hi everyone, welcome. If you are a new joiner or a new subscriber, welcome back. If you are a returning subby, please don't forget to subscribe if you haven't done already. Let's grow the channel. Someone on the channel said they love me. I responded that if they have a beard and they are as tall as their fridge, then I love them too. It's always nice to see love, so please just also tell me you love me in the comments, I guess. I have discrimination though. If you're tall and you have a beard, I love you. If you're not, well, we all know how if-else statements work, right? Like I said, welcome back to the channel. So there's also someone who commented that they really enjoy the investment property. They enjoy the investment property. I don't want to say series because I only did one or two, but they enjoy the investment property episodes. So that's what I'm basically going to be doing here. I'm going to try and do like a property in Cape Town because I've also got something to share, which is an additional leg in terms of information, because there were also quite a few people who asked me where I get my information in order to decide whether to invest or not. So I've got a TPN investor report that speaks to Cape Town as a whole, very fresh. I got it on the 20th of June this year, so it's very relevant, and that's why I'm choosing to stick with Cape Town here. We're going to find a property in Cape Town that we like. We're going to put it in the 20-year model that was developed by Mzansi YouTuber, and that I added a few features onto. And after I'm done with that, I'm going to read the Cape Town report and find out what we can gather from that, and then you guys will go in the comments, and besides saying I love you, Tando, you'll also tell me, is this investment for you or is this investment not for you, and why or why not. Okay, let's get into it. All right, we're going to look at Cape Town. We're going to keep the price pretty neat. Let's keep it at 7. Let's keep it at 800. We're going to look for a 2-bedroom, and then we're going to look for an apartment or a townhouse, right? You're not going to see a lot. 61. Only 61. And the thing is, I don't have other filters, as you guys can see, right? I've literally just selected apartment, townhouse. Let me add house as well, not because it's going to change anything, but because sometimes agents make a mistake, right? So it's a 2-bedroom house, apartment, townhouse. Now it's 189. Okay, that's a bit better. But let's also put a minimum of about 600,000, because I'm looking for a certain, I guess, areas that are likely to appear on the property report. So those two need to go hand in hand. Bathroom doesn't matter. All right. Okay, we've got Wynberg. Wynberg is a great location. I'll tell you why. Wynberg is a good location because it's very accessible. This is a Grand Central. This is literally on Main Road. It's very accessible to public transport, and it's very central. If you guys don't know, Wynberg is in the southern suburbs, right? What does that mean? It means that it's super close to AUCT. It's close to Claremont, where there's a lot of asset managers, and where there are big malls, and where there are a lot of call centers, so a lot of girlies work there. It's also close. It's also accessible to town, where again there are a lot of companies that are there, and there are a lot of like employment opportunities in town, tourism, financial services. You name it, it's there. So Wynberg is the place to be. It's also accessible in terms of taxi to other areas of Cape Town. So like Wynberg is the place to be. So I'm really glad that we can have across something like this, and we're gonna have like an in-depth look at this investment case. So it's 780,000. It's a 2-bed and it's 68 square meters. Let's have a look at the pictures, right? Let's have a look at the pictures. All right, the kitchen. Look, if you're coming in as an investor, what you can do is you can probably like zhuzh up the cupboards with paint. Yeah, look, it doesn't look great. It's not going to be high end, but you'll get rentals. That's one thing about Wynberg. You're not going to struggle with rentals, right? It's got a built-in stove. It's gas. Oof. It's gas, but it's got a built-in stove. Oh, the stove top, sorry, is gas, which means that the electric stove may or may not be functioning. So that's the kind of thing that you want to pick up when you go to your viewing. You want to test as a stove, right? Yeah, so this is more of a look at the kitchen. The cupboards actually don't look bad. Actually, you could change the handles because it's got those button handles which are a bit outdated, but your night doesn't look bad. And then the roof looks like this. I've been to Grand Central to have a look myself for investment purposes. So the roof looks like this. There's nothing wrong with the roof in that instance. And I think they're using this as a separator to separate out maybe the other bedroom or the bathroom. I'm not entirely sure. All right, so at bedroom number 1, the one thing that you want to check is does this bedroom have a built-in cupboard? That's a mistake you can easily make. And built-in, I mean as in a cupboard that when these guys move out, they're not going to take with, and then when you get there, you're like, what? You understand? The room is quite sizable. I mean, they fit a double bed, and then they've also got space for a bit of a TV stand. There's a shower over the bath. Few things kill me more than a shower over the bath. This is bedroom number 2. Let's go back to bedroom number 1. Did we see built-in cupboards? Are these built-in cupboards? Yes. So bedroom number 1 had built-in cupboards, but then this is bedroom number 2. Are there 3 bedrooms? There are 3 beds, but there are 2 bedrooms. Okay, are we aware of that? What we're basically seeing is, I think this was creating another bedroom, which was sectioning off parts of the lounge. So that's why you see 3 different beddings, right? And then here you don't actually have the built-in cupboards, right? And then here you've got the main bedroom. I know it's the main because the cupboard has 3 doors. It's the bigger cupboard, which means it's a bigger room. Very spacious, right? Very, very spacious. I think there's decent amount of space here. So we're back to the outside. Like I said, Grand Central, it's very busy. It's very accessible. It's got a lot of interest. You could split it up for students, or you could have professionals, or young people who just started working, like abantu abasebenzayo, abantu abasatabaza. They've got basement parking. I think they've got basement parking, and I believe they also have a laundromat somewhere in the basement. So it's also quite nice if you do find someone who doesn't need public transport but has a car. All right, let's see what we can gather from the rental amount here. So that's basically just a description. And then we don't have levies, we don't have rates, we don't have anything. All right, so what I'm gonna do is we're gonna have to infer those, right? We're gonna have to infer those. So what I'm gonna take is I'm gonna take the 780. We're going straight to our property model, right? We're gonna take an offer price of, we're gonna put the market value. Remember what I said last time? Market value is how much the property is worth. We're going to assume that this is worth what they say it's worth. Of course, I can run a property report for a Grand Central, right? And I can take that and I can read off of that. Actually, I should. But this video is meant to be very small, and I'm trying to get as much engagement as I can so that I can understand which parts of the property valuation you guys are struggling with, or which part you want to know more of. But in market value is not necessarily what the agent says, and it's not necessarily what's on Product 24. That's basically what I want to be, the takeaway over here. This is like not necessarily what they say it is. So that's just something to be very, mindful of, right? So we've got the market value of 780 over there, right? I just want to separate that out. I love a good Excel. 780, that doesn't necessarily mean we need to offer 780, right? So here I'm going to offer 750 just to start with. I'm being cheeky. What is that? That's 96% of the market value, right? That's what I'm offering. I'm going to keep my discount at 6.25. That is basically related or close to the cost that I once saw for the bond amount of about 7K. That I would reinvest at, or that's the interest that I think I would earn if I was reinvesting this 7K monthly rather than putting in this property. I've shown you in a previous video that I got that from the FNB money savings website, but this amount is really up to you. It's how much you think you can get. So if you see 8%, Old Mutual is offering you 8%, but bear in mind, you're not going to put 750,000 because I'm not. You understand? We're bonding this amount. So we're assuming that you've got 7,000 per month that you're going to be putting in. So that's important because sometimes there are tiers to how much interest you're going to earn. I'm going too much into that. I'm going to put 1 rand here because my model breaks if I put 0. The transfer costs are automatically calculated based on the bond amount of 750. So it says here I'm going to need to pay 55,000. That's a once-off amount. Same thing with the deposit. Refurbishment, we said we're going to do a little bit of painting as wardropini, and we're probably going to remove the curtains that are and maybe there are holes in the the holes in the, you know, in the walls because of the partition, but it doesn't look like it needs a lot of work. And I'm saying this because it's not high end. It's literally for people who just need a place to sleep. I'm gonna keep the levies at 1.6. Again, you shouldn't be guessing this, and you also shouldn't be reading it off of this. Like, I shouldn't be coming here and looking for levies if I'm really investing. What I should be doing is I should be calling Larry. Hey Larry, I see you've got this. Can I come in for a viewing? You come in for your viewing. You write that to Larry. Hi Larry, really enjoyed the viewing at Wynberg at Grand Central. Considering buying as an investor, you'll understand that I need the financials. Can I get the financials of the body corporate, please? The latest audited financial statements. Can I please also get the latest City of Cape Town rates? Can I please also get the body corporate statement of levies? If Larry says no to any of those things, you step away. If Larry says it's 2,000, I can't get the statement, you step away. If Larry says because of papaya, I can't share the statement, ask Larry. Larry, happy, I understand. Can you redact the personal information and send me the statements, please? If Larry says no, what do? We walk away. Why? Because we're not beggars, right? It's as simple as that. So this amount I'm going to get from Larry, but I'm going to get it by seeing the actual levy statement. I'm not going to be believing, seeing, right? Rates will keep it at 400 as well. What I'm doing here is allowance for bad debts, but I'm going to get it from the City of Cape Town report. But I'm basically taking 5% of the rental amount, right? Now, this is about 7,500. I'm going to take this and I'm going to make it 8,200, right? Because Cape Town is expensive. But we're going to look at the property report and then we're going to come back and see if our numbers make sense. Do you understand what I'm saying? Right. So they're basically saying here the bond amount is about 8.7. I'm putting an interest rate of 13%. Let's go to property 24. Let's put 13% here. They're putting 750. Right. So 8786. I just want to show you that my maths, right? 8787, 8786. That's fine. All right. If I go like this, it's 8786. It's the same as what property 24 has. That is the beauty of being able to model, right? You can check your math live and not have to pause the video and gagazao, right? So the bond term is 20 years. I'm assuming rent is going to grow at 6%. I'm assuming levies and rates are also going to grow at 9%, which is higher than the rental growth. Already you can see you're going to see flames, right? Why? Because the rent increase are less than by it costs Zako as an owner. Right? I'm putting away 5% for repairs and maintenance, and I'm going to pay someone to collect the rent and place the tenants and sort out when things break, because I don't have the time for that. Also, I can claim this back from SARS. So in the short term, it's going to cost me what? What's 5% of this? What is that? 0.05 multiplied by my rental amount. It's going to cost me about 410 a month, right? But how much is my peace of mind? That's what you need to be, asking yourself. Okay, in terms of the lease up window, I'm going to put a 0. But in terms of the vacancy, I'm going to say it's going to be vacant 1 out of 12 months, right? I'm just covering myself. But again, these numbers we're going to have a look at when we're looking at the Cape Town property report to tell us what we can expect in reality. This is what Tando thinks, and then there's what the TPN report thinks. So those are two things that we need to keep in mind, right? So according to my model, why is this... I can't cross the line. Okay, something is breaking. I think I have everything though. What could be the problem? Leverage return, cash monthly flows. What's happening? What's D3 to G8? G8 should be about 20 years. Or it should be 240. Yeah, that's year 1. I'm summing everything from year 1 or month 1 to it should be about 240. Oh. 240. So what's the problem? is my IRR not working? Let's do. Let's do 10 years. What am I doing wrong? What am I doing wrong? B52. Guys. Yeah, I've got my values and then I've got my dates. And my dates are in the future, so what's wrong? Let's do. No, I don't understand what I'm doing wrong. Okay, we're gonna leave that. We'll just look at NPV in any event. Right, so according to how it's modeled, the unleveraged cash flow is basically what I would be getting out of this if I didn't bond the amount. If I didn't bond the amount, I was gonna pay 750,000 plus the transfer cost of 55,000 upfront plus the 3,000, which gives us the 808,000. If I had 808,000, like at the very beginning, I would put it out. It would be my initial cash layout at time 0, and then in year 1 I would collect 56,000 per month. What is 56,000 per month? Let me see. 56,582 divided by 12, that is about 4.7, right? Net. That would be cash after everything, right? But because we don't have that kind of money up front, we're going to be doing leveraged cash flows, which is basically saying I'm going and I'm borrowing money from the bank, right? Which means in year 0, I need to pay 55,000 or 58,000. What is the 58,000? It's the upfront cost, transfer cost, which you need to pay, right? Net 3,000. That's the 58, right? And allow 3,000 to sort out the kitchen cupboards, like we said, like we estimated. So that's the 58, and then this means that in year 1, you're losing 48,000. That is above and beyond you basically collecting money, paying it bond, paying everything. It means we're shorting at 48,000, which means per month the property is shorting at 4,000 as a pumapi from your pocket, right? So it's cash flow negative. That's what the property is. It's a cash flow negative property. At the end of year 10, it's basically saying you're going to make 410,000. What is that 410,000? It is this amount, right? It is the amount that the property would have accumulated to minus what the bond would be outstanding at that point in time. That's what gets us the 410, right? Very important. If you're holding for 10 years, let's hold for 20, because I thought that exit was the problem, but evidently this is just not coming together how I wanted to. Let me try and read the error. Let's see if Copilot can figure it out. Whoa, that's not very helpful. Okay, if I'm holding it for 20 years and it's going to appreciate at 3.5% per year, obviously the power of compounding means that the longer you hold something, the more you're going to earn, right? So if I come here and I'm holding it for 20 years now, it's still cash flow negative in year 1 and it's still 48,000. But does it ever become cash flow positive? No, it's cash flow negative until the very end. This does not look like a good investment, right? At the current rental of 8.2, which is about 4.1 per room, which is more than reasonable for a southern suburbs, right? So what I'm going to do now is all of these numbers are numbers that I have thought of. I'm going to go to the TPN report, which is supposed to help me fill in these numbers. And after it's helped me fill in the better numbers, we're going to see, based on it data now, not based on Kando's thoughts and feelings, based on it data, is this a good investment, yes or no? I'm just going to pull the report here, right? So it was generated by Jongilanga Express. That's where I got the report, and that's what we're working with here. Right, so I've chosen Cape Town as the town selected, right? It's going to tell me about the rental yield payment index. It basically tells me how good are people paying, and that's what the good standing ratio is. How does that come into my model? It comes into here, right? Allowance for bad debts. My current allowance for bad debts is 5% of 8.2. I want this to tell me, should it be higher than 5% or should it be lower than 5%? Allowance for bad debts, with my distinction in ACC 1006 S, F and ACC 2011S. I can tell you that the allowance for bad debts, from the top university in Africa, allowance for bad debts is basically how much, or the provision that you make for people not paying. So this is an amount that I'm supposed to be keeping as an investor in case my tenant doesn't pay. So when my tenant pays 8.2, funeka 410 out of like 8.2 after ndibhatale ibond. You understand? Iyayibona ubana already I'm in the negative because kwa ibond ayiphumi kule rental, but I'm supposed to keep the 410 in a safe place so that it can help me if my tenant doesn't pay 1 month. I've got this reserve that I can go and tap into. That is what the allowance for bad debts is. You keep this money or this proportion monthly, and this is based on the area, right? If it's a high risk area, you have to hold more reserves, right? If it's a low risk area, you have to keep low reserves. So that's why it's important for me to have these numbers, right? The yield information basically tell me the yield, which currently here is at 11%. So my model is giving 11%. So it's going to tell me in Cape Town, what are other property investors yielding? And how does this compare to that? This investment compare to that? Apologies for that, right? And then the TPN rental price index and price distribution. Again, that's going to tell me, Tando, ufake 8.2 here. TPN is saying add more, or TPN is saying add less. That's basically what we're going to be looking at, right? So I'm going to just make all of the amounts that we're going to look at our report, or compare to our report. I'm going to make them this, and color. I'm going to make it that color. So we said Nalapa. Right, so these are the amounts that we're going to be looking at. We're going to be looking for a rent. We're going to be looking for a allowance for bad debts. We're going to be looking for a rental yield, right, to compare that to. The rental amount is going to be an input, and the allowance for bad debt is going to be an input, right? I think the rental growth, I think we can get from the increase. I think we can also get from the TPN report that I got from, Chongilanga Express. Once that is sorted, I can come back here and I can have a look-see at what's what. The interest rate is a bit high, but what you want to do is you don't want to buy a property in a low interest rate environment, and then when you're in a high interest rate environment, you debt as well, right? So this is me being a bit on the higher end of things to make sure that my property portfolio can withstand interest rate hikes. And I could easily come here and put, prime, which is I think 10.75 if I'm not mistaken at the moment. Right, I think it's 10.75. But what good is that gonna do me when interest rates go to 13%, and then I'm like, you understand what I mean? So let's just be mindful of things like that. Right. Then it's gonna give me the property demographics. So who lives where, how much are they earning, what kind of jobs are they doing. So I said a Wynberg, I think it's a lot of students, a lot of young professionals, a lot of young people who are just getting into the working environment, a lot of families as well, because there are a lot of schools in southern suburbs. Do you understand? So this is going to confirm if I was right or I was wrong. Existing household demographics, again, it tells us, do we have family or do we have single people that are living one by one? Because it's a different demographic. Families tend to stay longer because and they need more stability, whereas one or single, like if something happens between you and your landlord, or you're not happy with something, easy. So these are the 5 types of 5 pieces of information we're going to be trying to extract. English, yeah? 7, guys. These are the 5 pieces of information we're going to try and extract from, this, report, basically. So here it's just basically showing us what Cape Town covers, or what areas Cape Town covers. So there's Mzansi, there's Constantia, there's Wynberg. So Wynberg is the property that we're looking at currently. There's Wynberg. So Wynberg is, I want to say, 20 minutes to town. It's close to Constantia. It's actually just behind Constantia, which is known for its wine farms. There's Latundo Bay, which is close to Sandy Bay, which is the nude beach. Then you've got your Table Mountain National Park. Then you've got Hout Bay. Hout Bay is so nice. Then you've got Noord, which is around the mountain. You've got Mzansi, which is the beach with those little houses. And we've got the rest of Cape Town. Basically, yeah, this is the area that we're essentially covering, report, right? Okay, let's go. Let me just make this a bit smaller. Okay, so in terms of sectional title properties, it's basically showing you purchase prices and volume trends, right? So what it's showing you here is that the average purchase price for sectional titles, so sectional title complex, which is what we're looking at, the Grand Central complex, the amounts are about 2 million, right? And we're looking at a property worth 680,000 or 780,000, right? So it's not unreasonable. That's what we're taking away from that, right? We're taking away that a 2-bed for 2 million, or it doesn't actually say how many beds, but we're dealing with 780, roughly there are 2 million, so it's not extreme, right? It's not too extreme. Oh, sorry, these are the volumes. I'm reading it wrong. So the volumes that have an average purchase price of 2 million, that's the volume. It's about 5,000 properties. Let's look at our market. So we're under a million. So in 2020, yeah, let's take that as 2020, there were about 3,000 properties that were under a million, and that's because a lot of investors, people who own multiple properties during COVID, they did cheese sake, especially in Rondebosch. In Rondebosch, for the first time since I got to UCT, I saw properties that were under a million. It's just that I was in Gauteng at the time and I didn't have enough money, but I would have invested in a property in Rondebosch at the time because they were selling like hotcakes. Because UCT had closed, so students were no longer on campus, and now you're sitting with 2 or 3 or 4 properties and it's vacant, which is fine, but the problem is that you don't know how long it's going to be vacant. So this number, right? So this lease up window and this vacancy rate for students, that's typically 1/12. Because students will rent from February to November. Most of them will want to stay on in December, so February to December, which means you only vacant 1/12. So what COVID did is COVID came and it was like 4/12, then 5/12, then 6/12, and then do you see how much money you lose, right? You see how much money you lose because you have to make like provision for a vacancy. So that's essentially what COVID did, and that's why you're seeing this negative or adverse drop in 2019, 2020. And then now we're in 2025, and they're basically saying there's about 1,000 properties that are under 500,000. So what's important to note is a lot of the properties that are 100,000 are a lot of the properties that are under 100,000 the average purchase price is actually, I'm reading this so wrong. Okay, let's start over. So sectional title properties, volume versus average purchase price. In 2025, you've got about 1,000 properties that are, yeah, I'm reading it right, 1,000 properties that are 2 million-ish. In 2020, you had about 1,000 properties that were 1.5 million. Yes, okay, now I'm reading it right. That is still pretty low. And in Rondebosch, everything I said was true. It's just that I was reading the chart wrong. But in Rondebosch, there were lots of opportunities during COVID for the reasons that I explained. But it wasn't a million, it was 1-point-something million. So for the volume, I'm supposed to be reading on this axis. And then for the average purchase price, I'm supposed to be reading on this axis. I was getting those two confused. Same thing for full title. I won't go into it because it's not what we're looking at right now. And then for investment properties, it's basically showing us on the map where do you have a lot of people or percentage of second properties. So percentage of second properties here, it's obviously increased from 1994. There were 40% of people who had second properties in Cape Town. Now it's closer to 48-49%. And where are those properties? Largely in town. You can see the dark blue is about 20 or 30%. That is very much Hout Bay, very much Cape Town, and then more than 50% also very much Hout Bay, very much Cape Town, and then 10 to 20% sort of inward. So the Wynberg that we're seeing, your Claremonts are here, your Rondebosches, that's where UCT is, etc., etc. So this is nice to see. It tells you that a lot of people own investment property in the area. So when you're coming in as an investor, you're coming in with other investors, and this gives us, this paints a picture of trust. You've got confidence because if you're seeing an opportunity, it means others are also seeing an opportunity. It gives you a little bit of trust. Okay, so you've got a rental payment index, which basically tells you how Cape Town, because we pulled the report for Cape Town, how Cape Town compares to what? The rest of the city. Or the rest of the city, right? Because it's comparing itself to itself. You can pull a province, you can pull national. Right now, we're only dealing with city of Cape Town. So this is basically showing me that the dark green is more than 5% and above. So it says here, rental payment trends for the specified area weighted against the national good standing report. So if it's light green, it means it's at natural average. And this means they're paying better than what a national rental are paying. And then here, better than 5% of the national average. So it's not that they're paying more, it's that the payment profile, like people are paying better, paying on time and paying in full. That's what it means. And then less than 10% or less than 5% and less than 10% the national. These are areas where it's basically telling us that people aren't like ababadali in time. Can we see that our Wynberg is there? Right? Can we see that Wynberg has a little bit of orange? So what are we gonna do? Because currently we've got 5% as our rental as our allowance for bad debts. Are we gonna keep it at 5 or we're gonna go to 7.5 just to be safe? I'm gonna take it up. I wanna be safe. I don't wanna do an investment on Excel and it looks good and then I get in and then I burn. So I would rather the model say no and then I don't go in, rather than the model say yes and then I go in and it's a no. Right, so that's what we're doing there. Off this, I'm seeing that the people here in terms of payment profile aren't paying as well. So I'm going to take this greater than 5%, but I'm going to take the 10% as a guide, as in it's not a dark orange, so I'm not going to go to the extreme of 10. What I'm going to do is I'm just going to take in between these two. It's modeling. You have to make an assumption somewhere. Think of it like you're in an ABSI test. Now we've got the good. This is too big. We've got the good standing ratio now. What is that telling me? It's telling me how people are paying. I love stats. Right. So green, 78% of people in Cape Town are paying on time. Right. 7.19% are partially paid. Right. So they're paying, but if it's 8K, they're paying like 7K or something. Right? So this is Cape Town's numbers, this is the Western Cape's numbers, and this is the national number, right? Paying on time in Cape Town is higher on a national basis. What is this saying? It's saying investing in Cape Town, you will far better than the country as a whole. It's stats. So it's not saying if you go and buy a property in Sandton, it's not going to perform as well as Cape Town. That's not what it means. It means Cape Town relative to the country is 69%. A property in Sandton might perform better than a property in Cape Town. A property in Cape Town might perform better than a property in Sandton. But on aggregate, it's saying a property in Cape Town, you've got 78% likelihood of your tenant paying you on time than 69% for the rest of the country. Right? Stats requires a lot of reading. Like you have to read it with understanding, right? Then you've got grace period. So I think that's 7 days, right? 7 days grace period is basically saying loan by the 1st, because rent is due on the 1st, right? This person hasn't paid by the 1st, but they've paid by the 7th. That's what grace period means, and they're saying in Cape Town that's about 3.15%, right? 8.6% are paying late. That's the risk. 8% are paying late relative to 11% nationally. 7.2% are paying partial payment relative to 10 nationally. 3% did not pay relative to 6.13% nationally. So Cape Town looks good. I'm not saying Wynberg looks good. I'm saying Cape Town looks good relative to the province, right? The rest of the Western Cape, and relative to national. That's the takeaway here. Now we're going to look at the residential yield. Remember, on our little property model, we had 11% as the residential yield, 11.43. Let's see what other investment, property people are earning. Right. So we're going to look at here Q4 2024, the latest investment, because we're getting it in 2025. The latest information is the one that's most relevant for us. So nationally, people are earning 11.1% nationally. Cape Town is earning just over let's call it 9.5%. And then town effective is slightly lower than that. Let me call it 8.5. Let me see if they explain town effective. Oh, effective yield is the return on investment after the percentage of outstanding rental payments have been deducted to show the good standing portion of the gross yield only. That's actually quite good because that's all that matters, right? If I've got two properties, right? If I've got two properties, one person paid and then the other person paid late or didn't pay or paid partially, then the effective yield is actually what I'm interested in and not this one. Because I can't take this to the bank, but the effective yield is money that hit my account, so that's actually more reasonable. So can you see that here you're expecting about 8.5, whereas our model is showing us 11.43. What does it mean? It means Wynberg is looking good. Granted, I thumbs up the levies, I thumbs up the rates because it's not on the listing, but with these thumb sucking, which are assumptions in an actuarial science exam, with these assumptions, this property looks good relative to the national average, which is what you're seeing here with the effective yield of 8%, because our property is yielding 11.4 comfortably, right? We're gonna go back and see what more we can get from here. These are freehold properties, again, not really relevant for us. Then you've got the rental price trends, right? So by property type, we're seeing 20k. That's the rental price range, right? So it ranges from about 6,000 to 20,000, right? For sectional title properties. The average rental being about 11. That's what the dark line is saying over there. And then you've got the freehold property as well. Let's look at the bedroom numbers. Let's do a 2-bed. So it's saying a 2-bed in 2024 was renting for about 14,000. And then in 2025, a 2-bed was renting at about 14,500. We're renting at 8.2. I think that's reasonable for Wynberg. I know Wynberg, right? And I know Grand Central, so I know why it would be on the low end. It's very full, it's very packed. Wynberg is very busy. It's close to taxi rank. So it's not everyone's cup of tea. That's basically what I'm trying to get to. It's not everyone's cup of tea. So you're not gonna go and list it for 14,000 and think you're gonna get like tons of people coming for viewings, right? So I'm happy to keep it at 8.2. If you've got comments about my 8.2, drop it down in the comments below. Tell me if I'm being mad. Tell me if I should push it higher. Do you understand what I'm saying? These rental prices are mad. Alright, so here are the 2 beds, right? So in 2023, for sectional titles, it's very important. You want to keep to the same property type because you're going to see flames when you look at freehold properties. Because there's a central circumscript. You're going to see flames. Almost 70,000. So for 2 beds in 2023, the market closed, it was about 7,000 to 12. Oh, average was 12. It went about 7 to 20. Now it's about 8 to 23. So we're at the lower end in 2025 at 8.2. I'm more than happy to keep it there, like I said. But if you've got comments, if Dimo wrong or Akrimon, let me know in the chat below. Alright, let's look at the rental price distribution. These are 3-bed, freehold. This is sectional title property. Again, it's just showing us 2 beds of the dark blue. About 20% of 2 beds are about 20,000 or 15%. Then you've also got about 18% that are 8,000. I'm happy with that amount. Then you've got about 18% again that are about 12,000. You've also got tail here of 36,000 2 beds. I'm just not the target market, maybe. Let me keep it at that. Here we're going to look at the rental increase. Why is this important? Remember we said we're going to get our rental increase amount here, the rental growth. So how much am I accumulating this? Because remember, this model is over 240 months. That's what you're seeing here, right? It's a 20-year model. Depending on your exit, it has to do all 240 months. So what do I do here? I obviously do a lease up, I exit. Here it's zeros because you haven't sold. But then if you sell after 1 year, it's 12 months, so it will have a 1 over there. So it's basically saying investment life, yes, the investment is open until it's not. So what you're basically seeing here is inflation on levies, inflation on rates, inflation on that. Then you've got your investment costs. Then you've got your rental. Let me see. Yes. So rent is where I increase. So I increase the rent here. So that's 8,200 for 12 months, né? 8.2. And then here I increase the rental amount by the rental amount I put in front plus the increase, right? So that's why it's important, because after 12 months, right, I'm at year 12. After every 12 months, I have to increase the rental amount, right? So I keep it here. I'll keep it here for another 12 months, right? And then I increase the rental amount again. Do you see that? That is the beauty of modeling, right? So what I'm basically saying is when I change this 6%, depending on what the PDF tells me, right? Depending on what the data tells me, I'm at the mercy of the report. Depending on what the report tells me, I have to change this rental growth to reflect the market and not what Tando thinks, right? So let's have a look. So it's basically saying greater than 10% down. So rent coming down, I'm not seeing that. But rent coming down, I'm seeing it. Constantia, Grassy Park, a little bit of Wynberg, but not a lot of Wynberg. Let's say on the side of Wynberg. Then you've got none, which means rent stays flat. There's no increment. I'm seeing that in Maitland. I'm seeing that, I don't know where that is. Up, I'm seeing the dark green again in some parts of Grassy Park. That's probably Ottery. Yeah, that's probably Ottery. They've got this nice complex called Estee Melville. And then they've got a bit in Falls Bay. Or maybe Mzansi is here. I don't know. But, and then greater than 10% up. So you're seeing some of that also in Wynberg. Look, this is hard to read on just a map, especially for sectional. But what I'm seeing here is that generally, rental increases went up for Wynberg. Wynberg is green, but it's not dark green, but it's also not light green. So up is what we already have, and we've got an up of 6%. I'm going to keep it at that until I find information to actually confirm if there is any here. We keep scrolling, and then there's property type. So now it's basically just telling me what type of properties are owned in the whole of Cape Town, because remember, that is the universe we chose. It's telling us 55% are freehold, flats make up 27, others 8.8, and then cluster, which are townhouses, about 10%. This is not really material for, or this particular is not really material for our investment case, but this is quite interesting, right? So this tells us, are the properties bonded or not? Why is that important? Because we're coming in as leveraged investors. We are borrowing money from the bank. Excuse me for this thing breaking. We're borrowing money from the bank. So we're a leveraged, investor. So we want to know how many other people are also leveraged investors. What does that tell us? It tells me if the majority of people in Cape Town are borrowing money to invest in Cape Town, it means that they are likely making money, which means that if I also do the same thing and I model correctly, right? I don't just wake up and buy a property, I model correctly, then it means that momentum wise, we're riding the same wave, right? But if a lot of people are coming in unleveraged, if a lot of people are coming in and buying the properties cash, and I'm coming in and I'm buying leveraged, you have to remember, if I'm leveraged, my bond is 8,000, my rent has to be slightly higher to cover my costs. But if someone is coming in 100% unleveraged, they could undercut me with rent. If they rented out by 7.5, I can't meet that. Do you understand what I'm saying? So that's why it's important to understand the market is largely leveraged versus unleveraged. You get me? I think that would be important for me in my investment portfolio. Right, so let's look at not all properties. Let's look at sectional titles, so flats, right? So it's saying the 4,302 are owned or bonded, right? And then 6,300 are owned or paid off. 25,851 are rented. So 25 out of the 37 are rented. What does that tell me? Let's say 25,851 divided by 37,476. That's 70%. That's telling us that 70% of the flats in Cape Town are rented out, right? So what is the likelihood that you buy a property and it's vacant? It's low. It's low. It's 30%, right? Because if it's not rented, it's either owned and paid off and you're not renting it out, you're living in it, or it's owned, bonded, and you're living in it, or other. Not entirely sure what other entails, but it's such a small percentage, I'm not going to lose sleep over it. Or it's rented, right? Tell me again if you don't agree with my math, right? Tell me if Dimo wrong, right? Like I said, this gives you great confidence in the investment case. That's my takeaway from that page, right? Now we're coming on to the property size. We've got here that this property is 68 square meters, if I'm correct, right? Yeah, I told us it is 68 square meters, right? What is this telling me? Oh, it's telling number of bedrooms, not size. So 1 to 2 bedroom, 8% of all properties, 4,300 flats. I don't know. I'm not really gaining any information from this, except that's a nice step chart. I don't know. I don't know what I can take away from this that's valuable for our investment case. Household size is quite important though. So household size of, let's look at 2 or 3. So of the rented properties, 25% are people of 2 people, right? So that's either 2 friends, 2 flatmates, 2 students. It's a brother and a sister that got out of uni and they're renting a place together. It's a mom and a kid. It's a mom and a dad, but without the kid. So it's just a woman and her partner, or it's 2 guys that live together. It's 2 girls that live together, or yeah. I think that's a very sizable proportion. Then you've also got the single girls, all the single ladies. So you've got 35%, right? 35 plus 27, I should have been able to do that with my head. 62%. 62% are 1 or 2 people. Why is that important? If you're renting a property out, you don't want tons of people in your property. Why? Because it's flat, Lena. So like, you don't want always hearing from your neighbor, there's noise, there's this. You don't want to go through body corporate. You don't want, so it's nice to see that all rental properties, 62% of people are either renting alone or they're renting 2 people. Flatlets, I think that's what I'm gonna call it 17. I'm gonna say 17,500 plus 11,500. 17,500 plus 11,500. 29,000. 29,000 are flats, right? I think that's positive. 29,000 flats have either 1 or 2 people. Bearing in mind that a lot of these flats are 1 or 2 bedroom, right? So it checks out. I'm happy with the household size. But again, this is very big. It's not telling me the household size in a complex or an area, but it's telling you Umasipala, city of Cape Town. This tells us the population of people that are residing in Cape Town. This is not really relevant for the purposes of our study. And then you've got the language and education. This could be important if you've got kids, right? And you want your kids to attend a school that has their mother tongue, right? Here you've got English, you've got Afrikaans, you've got 11% of unspecified and 4.5% of other, right? The picture here is very, very different from the June 2025 City of Joburg PDF that I also pulled. Okay. Then you've got household age, head age, right? So for flats, you've got 48 under 16, which are household head. I'm not sure how to interpret that. Then you've got 1,700. I wish this was in percentages. All right, let's look at all properties rather. You've got about, let me look at young people who are working. All right, so I'm gonna take 10 plus 9.5. Let's do 20. That's 30, 35. So 35 people I want to say are working age, right? Young, right? Then I'm gonna add 41 to 50 because those people will pay the rent. They don't have time for nonsense. So you've got 50 plus 20, so that's 70% of people that are working. They're waking up, they're going to work, they're likely to pay your rent. That's my takeaway from this. Employment status, which actually adds to the investment case. We've got about 35 people, or 36% of people in Cape Town that are employed in the formal sector. We've got 2.5 that are in the informal sector. We've got 3.5 that are in a private household. I'm not sure what a private household means in employment status. And then you've got about a total of 58%, which are unspecified. I'm not sure what to make of these numbers because that's 60, that's already 95, okay, 97, okay, all right. I think this is slightly over 100 unless I'm calculating it incorrectly. Oh no, I'm not. It's 100 exact because that's, yeah, that's already 71. Oh, sorry, 91. This and this are 91. And then, 94, sorry. 94, and then this is 6%. Okay, that's fine. Then you've got annual household income. This is important because we saw that the average rental ranges from about 8 to about 12,000 for a 2-bed, if I'm remembering correctly. So this can tell us if people can comfortably afford the rental of 8.2, which we put in our model. So for all properties, or let's look at rental rather. For rental properties, you've got, 9,000, you've got 6% of people that are in this 9,000 to 19,600 band. In this 19,000 to 40,000 band, you've got about 8% of people. So what you want for a rental of 8.2, or what agents usually do, is they'll take the 8,200 and they'll multiply it by 3, which is 24,600. So our people are people that earn 26,000 and more. So this is the band that we would be interested in for the purposes of our exercise. We'd be interested in someone who earns 24,600 or more, which is basically this, and up, obviously, right? Because there's nothing stopping someone who's earning 1.2 million from renting your 8,200 rand apartment. But we'll look at this and maybe this one as well, because typically the high-end people who earn a lot will live in areas like that, and people who earn in the middle will live in areas like that. Typically, there's obviously rich people who don't earn a lot will want to live in, will have aspirations of living in a really fancy area and will rent up. And there's also people who will want to pinch and save money and they will rent down. But largely, for the purposes of our exercise, we're going to take these two people who earn more than the 24,000 that is required, and we'll take these two people and we'll say that is about 22% of people in Cape Town can comfortably afford our apartment, a Wynberg, that is renting for 8.2. That's sort of the takeaway, right? And then we will not do anything because that is the end of the report. I'm going to cut the video here. We've done a lot. We've seen a lot. We've changed a lot. Tell me what you think about this investment case. I don't think it looks good. Overall, I'm losing 351,000, right? That's what it's saying. At a discount rate of 6.25%, if I'm holding it for 20 years and I've got a bond or interest rate that I'm given of 13% for 20 years, with these levies, with these rates, with this allowance for bad debts at this rental amount, I'm offering the agent 750,000, even though they're asking for 780,000. I'm going in now. What June? Let me make it July. I don't think that'll make a difference though. It's still saying I've got no business being here. I'm losing money. It's saying I'm losing money. It's saying don't do it. So I like to run these models before I go to viewing, so I wouldn't go to this viewing. Do you see how much time I saved for myself and for you? Thanks again for coming through. I'm going to put this I'm going to put the link to this property in the description. I hope this wasn't in the way for what's her name, the model that I was showing this whole time. I hope this wasn't in the way the whole time. So I'm just gonna move the picture out. This is what the model looks like. This is what we were looking at. I hope it wasn't in the way of this as well, because I was speaking a lot and I didn't notice that the file was in the way, possibly. Apologies for that. Let's chat in the comments below. What do you think of this investment property in Grand Central and Wynberg? Is it in? Is it out? What do you think of this TPN report that we've been going through? Is it helpful? Is it not helpful? What do you think about the rental amount of the 8,200? What do you think about, you know, the offer that I've made, 750, which is only a 4% discount? What do you think about the allowance for bad debts? Is it too high? Is it too little? Yeah, let's chat in the comments. Thanks so much for watching thus far.